Elena Philipova from LSEG Data and Analytics, because obviously the data analytics is what I would refer to as the old style data vendor, as opposed to the London Stock Exchange Group, the stock exchange. Welcome to David Anderson Talking Market Data. It's a pleasure having you on. And just for the audience, I'm going to ask you to do a brief introduction of you and a brief introduction of LSEG Data Analytics, but I'm going to put your LinkedIn profile and a URL for LSEG. But again, the focus of our conversation for anybody listening in, this is going to be ESG. Hopefully, a mixture of a deep dive into ESG for those people who are really into ESG, but we'll start off with a bit of an idiot's guide, a bit of the basics. So if anybody is an expert, I'll put some sort of note, maybe a timestamp, where people can jump to if they want to skip the idiot's guide bit. So first of all, who are you, Elena? Why should we listen to you about ESG? I always listen to you.
Good morning, David, and thanks for having me. I had sustainable finance at the London Stock Exchange Group. I'm
glad it's not just me who trips over that long name.
I decided to spell it out the first time, but then from here on, I'll be just referring to us as LSEG, of course. I lead our sustainable finance solutions business globally, and have been pioneering and advocating for the importance of ESG data and integration into financial decision making for now more than 20 years, believe it or not.
Yeah. It was high school where you started that, isn't it?
I wish. But indeed, the industry has phenomenally changed in the last 2 decades.
I'm trying to remember when we first met. When your plane wouldn't allow you to sit on the FISD panel, but you were still in time to join the drinks. That was my first introduction to Elena.
That's right. It's been definitely a couple of years, and it's amazing that the discussion around ESG data has been on the stage, on the FISD stage, and other conferences for quite some time. I would say that the conversation has massively evolved from what is it, why should we care, to now most financial professionals do care, and they very much know why they care. But the conversation has evolved into, how do you do it well? How do you get the right data, and how do you use it in the right way?
And that's what we're going to get into. But I think there might be a few people listening in who still don't really understand this. So I'm going to ask you, I'll throw in a few thoughts as well, but I'm going to ask you to sort of do the basics. I mean, again, just ESG. Environment. So is it environmental or environment, social and governance?
Environmental, social and governance data.
Yeah. And again, I mean, environmental, I think we all understand. That is the traditional green dimension in it first. I think social and governance are sometimes harder to understand. Can you give this sort of idiot's guide to what social, the S and the G are?
Yeah, and I'll actually start with environmental pillar or dimension of ESG, which most people understand as climate-related data, but there is so much more to it. And clearly, the environmental ecosystems are very much interlinked and interdependent. But it does include data on nature and biodiversity, on pollution and waste, and how companies impact the environment through their activities. Social, as you rightly said, is a lot softer and harder to standardize and quantify. There are also country-specific rules and regulations that require or prevent companies from asking certain specific questions, which makes it more challenging to measure in a consistent way and comparable way how companies are impacting society, including their workforce and consumers. And governance probably is the easiest and most mature of the three topics and thematics, because it is something all companies care about and understand well who manages the organization, how is it governed, are there conflicts of interests, and how are shareholders treated. So there is probably more information and maturity in terms of G than E and S.
But I think, as we're going to discuss later, each of them is it vague, ambiguous? I don't know what the right noun is or adjective, whatever. It's difficult to actually pin this down or to quantify. Again, that's, to somehow put it in numeric terms, which I think everybody wants to do it. But also, when we had a chat yesterday, sort of setting the scene for this, the way I wanted to look at this was trying to come from the bottom up, try and describe all the different players in this game, if I can call it that. And I'll play, in my mind, the way I see it. And then I think that will lead us into the discussion of how each different participant participates and is affected by others. So arguably at a starting point is you and I, as individual investors, we may or may not have an interest, a driver that says we want to invest in a particular way. And the ESG credentials might be that shining light that we want to follow. But then when we want to follow it, that following it falls into two camps. Either we're going to invest in individual companies, or we're more likely to probably invest in funds, mutual funds or ETFs or whatever, which then brings the next layer involved. You've got asset managers who are trying to service individuals like you and I, and effectively provide funds, but then they've got to attach data points to that to be able to communicate with us, the investors. And then another level up from there is the sell side, the big investment banks, who I guess are in advising the buy side or whatever, and they need to have all sorts of metrics. So all these different players. So there's the individual investor, the sort of asset manager, the big investment bank sell side. So that's a little group. But then to the side of that, you've got the individual companies that we're talking about, the companies that you want to find out about, that are either in a fund or you're investing in them separately. And then you've got governments and regulators. So, I mean, there's so many different players in all of those. So that's the way I'm thinking about it. And all of those different entities, well, the investor, the asset manager, and the sell side firm all want to see data, proof, something to guide them in how they're doing the investment. And that data has to come from these companies that you're tracking. And again, in fact, let's dive straight into that. I mean, the phrase I've heard often talked about is disclosures. Where does this information come from? How do these companies provide the information? And I'm just going to throw in that the government, because the government and regulators, I think, this is where I really want your help, I presume they're regulating what the companies have to do. But I think they also regulate the asset managers. I mean,
they regulate every player.
Disclosures. I mean, scope 1, scope 2, scope 3. I've been looking that up. I mean, it's not easy, that disclosures bit, is it?
No, it's not easy, and that's why you see it taking quite some time to pin down what data is required, how to collect information and disclose it effectively with those different stakeholders in the ecosystem. And I would probably start by saying that the industry around ESG data was more or less self-driven, self-regulated, bottom-up by the market for quite some time. And I think we've realized that on a voluntary basis, change can happen, but it's incremental. It's not fundamental, and it happens too slowly. And this is the reason why a couple of years ago, more and more regulatory entities around the world have published their climate sustainable agendas and started driving the change that needs to happen more fundamentally across the global economy. And you rightly point out that disclosure regulation is the key driver of how one drive change. You need to have information, you need to have the data to start firstly somewhat accurately measure the impacts that we have currently, set targets, and then measure progress towards achieving those targets. So it's all about disclosures and data. Very few sustainable finance regulations today talk about behavioral change, of what should the industry be doing or what companies should be doing. It's all about provide the data to your stakeholders. And there are disclosure regulations for companies because it all starts from an investment perspective with investable entities. For many of them, it's the corporates that publish either equity or have bond issuance. And then those get rolled up into funds and ETFs and used in indices and benchmarks.
Aren't these companies motivated to do this because they want people to invest in them? Has that been enough of a driver, or is it a combination of that motivation and the regulators? I mean, which is the stronger?
I mean, it's very interesting because especially here in Europe, we've been now seeing the development of the sustainable finance regulation for good 7-8 years. And it's interestingly enough, the sequencing of those regulations was something that the industry was and still complains about. And the sequencing first impacted financial professionals that were required to provide ESG data about their financial products and impacts.
For example, asset managers. Is that the
Correct.
sort of broad? Yeah.
And the corporate reporting requirements and regulation only started last year and now got delayed through the omnibus regulation, where CSRD is there is a stop clause in a lot of regions impacting lots of companies to report with a delay of another 2 years. So what happens is that financial institutions already have to report, but companies not. And how are they reporting? Well, they rely on the information that companies make available on a voluntary basis. So it's the financial professionals that are putting pressure on companies to disclose. It is not yet the regulation that's mandating that reporting.
And that voluntary, again, the impression I get, it isn't all these companies sitting there thinking, we're going to create all this information and send it out. It's because companies, boutique originally ESG providers, knocked on their door and said, here's a 45-page questionnaire with 340 questions. Please fill it in. I mean, is that how disclosures have
That's
worked?
how they originated. That's how we used to obtain a lot of ESG data probably a decade ago.
Okay, I'm out of date.
Where a lot of companies would describe the way that the state they were in as survey fatigue. They used to receive lots of requests for information from data providers, from large asset managers and other organizations. And they would ask them different questions or similar questions, but different ways. And they would spend a lot of time
non-standardized,
Yes.
Yeah.
There is that's still happening today, but to a lesser extent. There is more reliance on their public disclosures, especially amongst ESG data providers like ourselves. Who primarily extract and collect information from public reports. And with the emergence of regulation, that's making the disclosure processes for companies a lot more standardized.
And these public reports is a sort of proactive, them broadcasting information as opposed to people knocking on their door and asking them questions. And that shift, is that because companies have recognized it's necessary and important? And is it, I mean, what's your pitch? I doubt there will be many corporates listening in on this, but if there were, what's the motivation for a corporate to do this the right way, the best way? Why would they want to do that? It's because they just want more people to invest in them.
I think ultimately that's the primary motivation, and any disclosure has to get approved by lots of different teams in the company, legal compliance, IR, comms, and so on, but also sign off at the board. And unless there is financial incentive and rationale for doing that, it's hard to get approvals to release more information publicly than what the company has to do. And that's what we've been hearing from lots of organizations. So the primary motivation so far, I believe, has been the financial and access to capital. It's what the investors need and demand from organizations. Therefore, we provide the data. But the good news is that with the emergence of more mandatory reporting, and by the way, sustainability reporting standards have been around for decades too, encouraging for companies to think about sustainability reporting in a strategic way, in a way that it enhances their financial reporting. It provides a more comprehensive picture of the company to inform better valuation of the organization. And it enables investors to cover better their blind spots and produce more comprehensive risk-adjusted return assessments. But a lot of companies are bringing sustainability into the boardroom, and that's changing the dynamics. And this is when sustainability moves from an obligation of reporting and checking the box exercise to a strategic enabler of growth for the corporates. And those companies that are able to think about sustainability that way, they are moving beyond seeing sustainability reporting as a cost center, but actually as a growth enabler.
As a genuine marketing tool. I mean, you mentioned IR, investment relations, so they want to sort of advertise themselves as being good corporate citizens. I mean, I'll throw.
And not only that, David. It's not about marketing and PR. It's about running the business the right way and creating sustainable growth opportunities. Because if businesses are not managing those so-called longer-term risks, they can get very quickly hit very hard. And we've seen quite a lot of examples where stock prices drop 50 or more % in a matter of a day or two because of a large ESG scandal that they didn't manage that risk properly before it occurred.
In fact, as a thought just occurred to me, I don't know the right way of phrasing this, so I'll use my clumsy language. When you're talking about companies, I'm presuming the sort of disclosures we're talking about, the information we're talking about, is them disclosing what their impact on the environment or on society or how they do governance. So it's about them and how they affect all of those different things. But then another dimension I'm aware of, and I don't know if this is different, is how they are impacted by the environment. In other words, if you're a big company requiring certain minerals, resources, if they're going to run out, or if drought is going to massively, if you're growing strawberries, or I'm making this up as I go along, but if your impact, and that's different, isn't it? How you impact and how you are impacted. How is that?
And that is,
covered?
There is a term used in the industry to describe exactly what you are heading towards, which is double materiality. And this is how organization impacts the environment, society, and equally how environmental and societal macro changes and shifts are impacting businesses and their ability to produce the products and services in the long run and meet the needs of their clients, and thus develop and generate financial growth. Is that
two separate data sets, two separate scores?
No, well, it can be, but it can be also one. The challenge is that we as an industry don't have yet a commonly agreed definition of what is this two-dimensional materiality for each company and each sector around ESG topics. And it's really hard to get to an industry-wide definition that everyone agrees on, because each organization's business lines and compositions and impacts and sourcing practices that are different. But in terms of disclosures, if I can connect it with the topic of discussion we were just having, some standard setters encourage companies to disclose based on double materiality assessment. So not only provide information that's financially material, meaning those macroeconomic changes and how they impact your financial performance, company A, but also provide the information of how you impact environment and society, even if that's not financially material today to your business. Standard setters that focus on double materiality are, for example, the European Corporate Sustainability Reporting Standard and GRI. But other
GRI?
standards...
Sorry, GRI.
It's GRI is it used to be the Global Reporting Initiative and is the oldest global sustainability reporting standards that's quite widely
There are
adopted
so
by
many
companies.
acronyms
Indeed,
in ESG.
indeed.
Well, ESG is an acronym. Anyway, keep going.
Absolutely. But then there are standards that are focusing on financially material ESG reporting. And the ISSB, which is the International Sustainability Standards Board, formed from the IFRS with the task to create global sustainability reporting, has taken a stand of expecting and companies to report on the ESG metrics which are financially material to the company, because the primary user and stakeholder of that standard is the investor. It's the financial.
And you IFRS. Now, IFRS is the accounting standards. Balance sheets, profit and loss, classic company reporting. And you and I were chatting about this, and I did my chat GPT. I tried to identify the history of financial reporting, because I think it's analogous in the sense that, well, it's interesting because I look, it's only in if you there's a difference between the UK, Europe, and North America, and I think the US still haven't agreed. They still have US GAAP, GAAP, not IFRS. So there's an interesting that even the financial reporting, which I thought was mature, it only really got mature in the 70s, from what I can see. And even now, the US is not the same as the rest of the world. I don't know where I'm going with this. It's an observation. I suppose what I'm getting at is lessons learned from that dimension and so the
globally
company...
accepted reporting standards is kind of an utopic, maybe an utopic idea. Yeah. If we make an analogy with financial reporting, and I, like you, often make that analogy and define ESG reporting as kind of the small brother of financial reporting, walking a couple of decades behind, but we got to walk a lot faster, just because the challenges of our time are so urgent and so pressing, and the risks and costs are potentially so high that we don't have time to wait for decades until the standards develop and mature.
But for financial reporting, in essence, it's numbers. I mean, balance sheets, profit. I mean, they are really numeric things. Whereas the ESG world, trying to put it into numbers, to quantify it, it's more vague, qualitative type things. And then how do you turn them into numbers? I mean, again, that's the sort of question. I mean, how does it get to? Are the numbers there, and it's just a question of which number you pick, or is it a qualitative thing, and how do you turn that into a number?
I mean, majority of sustainability reporting data is qualitative, and it's usually narrative text. It's not even a yes, no, or a word. It's actually a description and a text that elaborates the vision of companies or the process a company puts in place to manage a certain risk, or how they are going to improve over time. So that's definitely a disruptive element that sustainability reporting is bringing on to what financial reporting has accomplished.
But things like carbon emissions are very numeric. It's a certain quantity. Yeah. So that bit.
Across all ESG categories, topics or thematics, it's a mixture between narrative, semi-narratives, and numeric information. You cannot only look at numeric information because you need to understand the context within which the numeric data is reported. But there are users and use cases that can and do focus exclusively on numeric data. Because if you think about large fund managers that invest in thousands of securities, there is simply no capacity to read through the narrative texts. And the role that data providers like LSEG play in that case is that we translate critical narrative texts into Boolean questions that are then easily translated into ones and zeros and can be built into larger quantitative models, which require quantitative information to be able to assess the data.
I don't know if you're going to hate me for bringing this up, but doesn't AI, generative AI, is that a helpful tool? Because you've got all this narrative, and what generative AI is potentially quite good at doing is extracting meaning from narratives. I mean, is AI?
So
are you?
We definitely are leveraging and using AI technologies to help us do that in a smart way. We see AI technology as an enabler to our people to produce more intelligent information faster and better for our customers rather than to do the job of our analysts. And the main reason for that is as long as ESG data is not standardized and there are no industry agreed and accepted definitions adopted by all companies in their disclosures, AI technologies can only help individuals but cannot do the job of individual, even the most mechanical job, because the quality of the data sets produced are not acceptable in the context of investment decision making, where quality of the data has to be very high, and the tolerance around error is very low.
I mean, are you finding when your customers, which are probably more not individual investors as much as asset managers, sell-side firms, hedge funds, whatever, the classic institutional capital markets folk, are they asking for the same thing? Or are they all asking for different things? In other words, is it just, one company wants it this way, another company wants it another? I mean, is there any sort of standardization, any communality of demand?
No. but that's, in my opinion, that's a good thing. And I'm not surprised by it. If you think about it, I mean, there is no one size fit all, even in financial modeling and financial, traditional financial valuation. That's what those investors and quant analysts or portfolio managers, that's their value add on top of the data to create products which are better than their peers. That's what allows them to differentiate their propositions. Our focus has always been not to replace investors, not to tell them how to invest. We empower them with facts and trusted, transparent data so that they can incorporate it into their more traditional models, views, and enhance what they do and gain a competitive edge over their peers.
And I think that's a segue when we're talking about the data, because we're a data. This is all about the data. And I mentioned it to you yesterday. I'll bring it up again. This concept between ratings. We often hear about ESG ratings, and occasionally that's compared to the sort of credit ratings agencies of AAAs and all this, and trying to come up with some sort of code that is a good or bad or a spectrum. But then I have heard on panels and what have you that sort of asset management firms, they don't want the vendor, you guys or others, to do that for them. They say they want the raw data. I suppose the value add you are bringing is collecting that data. That data is all out there. They could, in theory, go and collect it, but it's an enormous chore to do that, and it makes sense to go to you guys. And there are a couple of other firms that also do it, but of course, LSEG Data Analytics, is out there. So the raw data versus the rating. I mean, explain that a little bit. I mean, what's that all about?
I mean, in general, the way to think about ESG scores or ratings is that that's the tip of the iceberg. That's only showing you if you aggregate lots of very different thematics into one score, what it looks like. But it has to be clear to everyone that in a way that compensates bad behavior in one area with good behavior in another area, which probably is not acceptable by many users, not all, but many users. And therefore, most users of ESG data and scores in particular never stop there. They go a level deeper in terms of looking at the different thematics and trying to understand where are the specific risks across their portfolio investable universes so that they can either manage them or price them or divest. Whatever they want to do, they have to go deeper into the data. Investors adopt different investment approaches and strategies. Some engage with the companies to drive corporate behavioral change. And that's very impactful and widely adopted practice for investors that actually hold large stakes in companies and are vested in the success of the companies. So, but it is quite time consuming. And so the ability to engage with companies tend to be limited to dozens or hundreds of companies, but not to thousands of organizations.
Is that therefore, is ESG now a strand of equity research? Because you had, that's a whole other topic, research, which is predominantly done by the sell side for the buy side. Sometimes the buy side do it themselves because they're all looking into more narrative about the companies that they're going to invest in over and above the basic financial reporting. They want to dig deeper and what have you. And as you was, they would have sometimes conversations directly with those firms.
And we do provide data to the large sell side firms out there to inform some of the research that they write. And indeed, there is a lot of sell side research being produced on ESG and sustainability, digging deep into organizations, into portfolios, into thematics, macroeconomic trends. Most of those firms have the expertise in-house.
Right.
And when they have the expertise in-house, they tend to gravitate towards using raw data only and picking the best raw data across multiple vendors and create their own scores, their own view on sustainability. And the reason why that's required is that, firstly, that has to be defendable by the firm. They need to understand exactly what drives the score, what drives the performance, how are individual raw data points impacting the overall performance? Because if they make a recommendation, it has to be 100% defendable. So relying on a pre-canned score from one of the vendors doesn't give them that transparency or confidence to use it in their own recommendations.
But is anybody using these pre-canned scores? Who is using them and why?
Actually, lots of clients use them. As mentioned, it helps them look at the tip of the iceberg. And whenever you have large starting universe, you need to have an intelligent way to be able to group those companies in certain ways. So it allows you to do kind of your first step of the process by looking at the scores. But it is never it should never be the last step of the process. And also, to build your own assessment on the world, you need to have an army of experts in-house to do it. And not many organizations have that. It's not a cost-effective way to manage sustainability risk.
So it's a filter because you can't look at everything in detail. But if you use those scores to identify, well, maybe that sector, let's
Correct.
drill down into that. But that other sector, we haven't got time to do that, so we'll ignore that. That makes sense to me. Again, you can blame ChatGPT for this.
And maybe just one quick point on this, which is most clients we see also moving away from looking at one magical number, the score, and expecting to give them all answers to all possible questions and problems that they have. But rather they're looking at a compilation of the different thematics, pillars, other pieces of information, and creating what we call a dashboard view that gives them more of the fingerprint of the sustainable fingerprint of companies that they're investing in, or funds or other asset classes that they're investing in. So the industry itself is also maturing to move beyond the tip of the iceberg into a more comprehensive view to then manage those risks and opportunities a lot more.
And I want to come back to, again, a little bit on the differentiation between all the data companies, not specifically, but the sort of how do you differentiate? We'll come back to that. So hold that thought. But before we get to that, I'm still thinking about disclosures a bit. And as a couple of points, one is I actually looked at what's the approximate percentage of companies that have reported and whatever. And I got, again, whether ChatGPT is correct or not, but the rough idea was, for large cap companies, it was in the sort of 80%, and then mid cap, it was less, and small caps, it was much smaller. And then this whole concept of estimating, that you didn't have the actual information. So you used all sorts of modeling techniques to guess, frankly, estimate what those firms might have been. So that's one question, but I'll hit you with two at the same time. I don't know if they're related. They're similar. Private companies. We're talking about public companies who have public disclosures, but there seems to be a lot of interest also, not just in an ESG context, but generally in private company data. I don't know if it's fair to lump those two together, those two questions.
I think so. I think it's fair because definitely as disclosure requirements evolve and companies become more proficient in how to understand this data, how to collect it and then report it, the volumes of companies with sustainability reporting is absolutely increasing. And as more regulation comes in force, those numbers are going to significantly continue to increase in the coming years.
There's a lot not doing it.
Absolutely, including into private companies. But that is a disadvantage of many companies as we hear today. And I'll give you an interesting feedback that one of my team members who was visiting China a couple of weeks ago came back and said, it's very interesting that on the ground, in speaking to small organizations, Chinese companies that are suppliers to a lot of the large organizations, they are full speed ramping up their ESG data reporting capabilities. And when I ask, well, what's the driver for that? The main driver is European regulation.
Is that scope 3 where you have to
not only scope 3 across? So scope 3 is related to emissions data and the emissions data that companies are responsible for through their supply chain and the life cycle use of their products. But this is true across all ESG thematics. In CSRD, the European Sustainability Reporting Regulation, it requires companies to measure and report the impacts that they have across their value chains as well.
So the motivation of firms that are in these supply chains is, if you don't do this, then maybe one of those big companies that are buying lots from you will stop buying from you.
So the company buying lots from you is asking you to provide them the data because they need it to meet their reporting obligations. So it's like a domino effect that spans well beyond the boundaries of the regulations into the supply chains and impacts both public and private companies around the world. That's a good story that I believe, a very positive impact that we see on those regulations. But I'll come back to your question that indeed availability of data tends to be biased towards large companies and developed markets. As we move to smaller caps and more developing or emerging markets, the volume of data that's available is gradually decreasing. And so data providers fill in gaps by estimating data. And there are also estimate models are developing, maturing, and becoming more sophisticated from purely kind of based on the size of companies and their geography and industry.
And you're comparing it with similar companies, so we don't have information that.
Data.
Yeah.
That report data. In the context of emissions data, for example, you can compare it to companies of similar size, similar geography, similar activity, and proportionately estimate what their emissions can most likely look like. But there are more sophisticated models where you also look at the production data and other financial related key performance indicators to be able to estimate better the outputs. But this works well with some environmental quantitative KPIs. And it's impossible to estimate on social, for example. So those gaps cannot be filled.
Impossible or difficult?
With high degree of accuracy, impossible. If your tolerance to accuracy is lower, then it becomes possible, right? Yeah. There are always those trade-offs.
Actually, I think this bit of the conversation is a segue into what I was going to ask. You've got a series of data providers. I mean, again, as I look at the history of this, when I first met you, probably 10 years ago or something, I can't remember when it was, I did a Google search because ChatGPT didn't exist then. And it was like, well, please list all the ESG ratings agencies. And there were just almost hundreds of them, companies I'd never heard of. And then I've noticed in this last 10-year period that over time, those boutiquey little companies, I think you used to work for one, have been taken over by the big classic, the data vendors, Your Good Selves, S&P, FactSet, Morningstar, classically bought Sustainalytics. I don't know if Bloomberg aren't as naturally acquisitive. They tend to grow things organically. They're slightly
correct. They didn't buy companies.
It's just not in their nature.
They did buy a few smaller organizations, but they self collected and created their ESG data sets over the years.
So you've got a set of the classic large data vendors. You've also got some of the the credit rating agencies, the index providers. MSCI often comes up and is quoted in this space. I guess if you're on the customer side, if you're the asset manager, if you're the sell side firm, I doubt this really affects the individual investor. How do you pick your data provider? I mean, because I'm being a little bit facetious and provocative here. All the same data's out there and you can all get the same data. So therefore, is it all about how you gather that data, how you analyze that data, and then the final stage, how you present that data in a better way? I mean, those are the three elements. I mean, has everybody got the same data, or are you actually going out?
No, everyone has a very different approach to it, or a slightly different approach. Some providers focus on some more specialized data sets, and that's their strengths, or thematics, or every provider has kind of their key characteristics that distinguish them. However, the question you're asking is a question I think many people have asked. And therefore, there are companies that have emerged that answer those questions.
Okay.
Aggregators that bring those data sets, provide kind of key characteristics of each data set, and help users of the data find the right fit for their needs. Because it's the user need also that vary quite dramatically, as we spoke about it earlier today. And therefore, the way that the data providers have evolved is around use cases in mind. But it is hard for kind of new entrants seeking for ESG data to learn all those providers and pick the ones that meet their needs. And so therefore,
I've got a sense that there's a bit of hedging of bets going on, that you're buying from multiple data providers in the hopes that somehow with all of that, you're almost aggregating your aggregators.
But it's a lot also to do with people preferences, who is managing ESG at the firm and which data set they are familiar with, because that makes it easy for them to kind of do their job and not have to learn a new vendor. So what we've seen is that often as the ESG kind of business leads in the organization changes, their preference to vendors comes along with them, and they change the vendors. But that's quite costly. And what we've seen in recent years is, so most firms do not have just one ESG data vendor. They have 3, 4, 5, 10. And there are very good reasons maybe why there are so many. But that's very costly. It's costly to onboard the data. It's really costly to normalize and standardize it. And as there are cost pressures across the financial sector, we see more organizations centralizing that in two ways. One is technologically centralizing all of their data on a cloud environment and kind of streamlining that process and cleansing it. But the second way is through kind of rationalizing the vendors that they use to actually meet the internal business requirements.
I mean, it's very similar. I mean, I grew up in the market data world, the financial market data world.
Yeah.
And I remember years ago, banks, etc., would have a Bloomberg and a Reuters. It was Reuters when I was around, and then there was an interesting point in time when the cost cutting became important. They said we can't afford to have both. You've got to pick one, and there was a whole, and because obviously having both or even three was comforting to the user because they could sort of pick, but then it was expensive, and I'm sort of getting the sense that the ESG data world is obviously less mature, but and over time, it'll come down to a smaller number of companies.
Absolutely, we are in that phase right now as we speak. And you rightly point out that the differences across vendors are not fundamental, right? So, and especially across the main ESG vendors, if the industry, they all have similar coverage. They all have similar data points they provide or scores that they provide. They do small things differently and better in one area than the other, but definitely.
Do you find the customer requirements are becoming more common? In other words, years ago, everybody had a different sort of motivation, a different interest. I'm talking about asset managers, sell-side firms. Are you finding that customer demand is less of a, changing, more standard, not standardizing, what's the right word? Is more common things in common. Is that maturing as well? Converging, that's the word, yeah.
I mean, there's been definitely a lot of fragmentation, and that's whenever there is a new field, new space that people are experimenting in, there is a lot of fragmentation. And as ESG is maturing, that fragmentation is absolutely reducing. It's reducing in terms of vendors and providers. It's reducing in terms of data availability and reporting. And it's reducing in terms of what users do with the data and what their requirements are. So absolutely, although they still differentiate and do different things with the data, the general requirements are becoming more and more common across users of the data.
Let me again, in looking at the supplier sort of panorama, spectrum, whatever, as I see it, you've got a whole clump of people, firms like your good selves, the classic data aggregators, LSEG Data and Analytics. You've got another clutch of companies, of which you also have a player in this game, which are the index providers, because you guys have got FTSE Russell, but I already mentioned earlier on that MSCI are a big player in it. And then I believe, although I'm not as familiar with this, I don't know whether the credit ratings, Moody's, S&P, Fitch or whatever. I mean, is there a differentiation between classic data aggregators, index providers and credit rating agencies? Or is is it actually just all those people have decided to have a go at the ESG data world? Do you follow where I'm coming from? Is there a difference in how those three types of firms approach this?
I mean, probably what's important to highlight is that it's dangerous to think about ESG and sustainability as a standalone thing. It's a standalone investment practice or a standalone corporate matter or a data matter for that sense, which is the reason why we've been very natively integrating ESG data into our financial products and services. That's how you enhance the objective of the users to generate better risk-adjusted returns, right? So whenever you bring it closer to the index business or to the credit rating business, you start managing the machinery in a more effective and efficient way, both in terms of timeliness, quality, and cost. So I think that that's the main reason why you have seen that convergence in the industry across credit rating agencies buying or becoming ESG providers and index providers, building ESG businesses. It just helps them to manage a core part of their business close to the heart of the business, and thus doing a lot better job in doing so.
So as we're sort of moving to the 50+ minute section, I mean, is this whole ESG maturity thing, are we going to be done in 2026, or will it be not until 2027? Forecast. I want a forecast. Where's this all going? Where's this all going?
Well, if you had asked me probably 2 years ago, I would have forecasted that we'll mature a lot sooner. The world, as we know it, has changed quite a lot.
Politics, yeah.
Yes, politics, wars. I think just there are a lot of setbacks that we've seen, which I think have put a little bit of delay and slow down on the sustainable growth agenda for the world.
Yeah.
And we've gone in some parts of the world more back to basics and survival mode rather than thinking about sustainable future and long-term prosperity for everyone, right? So the focus and the agenda has slightly changed, and that's going to impact when we're going to be able to claim maturity for ESG and sustainability. We've also seen it in leading regions like in the EU, with the sustainable finance regulation going through the omnibus adjustments and doing quite delays to some of the requirements. But that's creating opportunities for others to take a lead. And we've seen very ambitious, innovative progress coming out of China, for example, which I think is surprising many today. I really would like to say and project that by 2030 we're going to be in a lot more.
But isn't that aren't there some governmental things into?
Well, there is the 2030 agenda as defined by the UN Sustainable Development Goals, which we are not moving alongside that agenda, so we're not going to meet the targets. But I do hope that we're going to leapfrog and in 2030 be in a lot better state than where we are now. I mean,
almost the politics that we were, talking about the UN and talking about the appetite for electric cars and all the things that are sort of more political and societal. But in the financial markets, this idea of getting a more standardized, more convergent agreement on what good data is or what data is necessary, do you think that will continue to progress in a positive way, in other words, more convergent? Or will it? Are you seeing occasionally, you just think that's happening and then suddenly it fragments again when some new concept comes out?
I definitely think it's converging, and it's converging fast. The way it may feel sometimes that it's going backwards or going more towards fragmentation is the question around how much do you want to solve for day one and for which stakeholder group. So if you're focusing on one stakeholder and focusing on key problems and challenges and risks, you can easily define the top 50 metrics that need to be reported by everyone. But as you think about what information regulators need, or NGOs, or trading unions, and the more you expand the list of stakeholders that are consumers of the data, the bigger the list and the discussion becomes. So I don't necessarily think we're fragmenting, rather we're not aligning on who are the users of the data. And that's part of the problem.
Elena, I always do this at the end. I mean, we talked about a lot, but there's even more to talk about, which we just don't have time for. So in the last sort of couple of minutes, 5 minutes or whatever, are there a couple of burning issues that we just didn't get around to talking about that you feel passionately about? Anything that the audience have not heard us talk about yet that you think they should? So, couple of final thoughts.
Sounds good, Dave. And I think that, I mean, if I think about it, I think probably the one thing that's top of mind of people when they think about ESG is what they hear from media.
Yeah.
And what we've been hearing from media in recent months is not a good story. It's a lot about ESG debt, the backslash of ESG. Yeah. And I think it's very important for your audience to kind of get an answer to the question, is that the reality? Is this indeed what's happening on the ground? And is ESG dying or not? And I will, with 100% confidence, tell you that no, it is not dying. It's maturing and evolving, which is the normal development stage that it should be going through. As we learn how to do better, it's changing and evolving. And in my daily conversations with clients, because we do service the global industry, we speak to users and clients around the world on a daily basis. When I ask them what is changing for them, the answer has normally been how we talk about it and what we say is only changing, but what we do on the ground is not changing, because the risks are very real, very material, and they're impacting us today and our customers and our ability to generate the right outcomes for them. So ESG is absolutely here to stay. Whether we're going to continue calling it ESG in 5 or 10 years from now is anyone's guess.
I mean, I hate that. I hate ESG. I mean, I think it's a silly
You're not the only one.
Yeah.
Many people have expressed this opinion. I am very agnostic of what term we use and how we describe things. It's the ultimate objective that's essential, and it's important that we improve how we manage capital. It's important to improve how we manage risks and how we talk about it to the owners of the assets that are being allocated.
And I think this is something I learned when I first met you, the separation between maybe your personal politics, your personal ethics or whatever, and recognition of the business side of things, which are fundamentally different. And even if the politics of the world has changed with populism and whatever, which maybe slightly sort of goes against the sustainability arguments or whatever, what I'm sensing from you and what I can understand is that sort of financial markets still need an awful lot of data about this, maybe even to somehow reflect that political change.
Absolutely. And I don't mind if users use ESG data to short stocks. I mean, what they do with the data and what are their political views and philosophies is none of our business as an organization. But the need for data, trusted factual data, is only growing.
And I think, as I often say in these, the more complicated it is, the more difficult it is, the better for you and I, because they wouldn't need us. I wouldn't need me to interview you. You wouldn't need. So the longer it continues to be a really complicated, difficult topic, that's good by me. So look, Elena, it's been a pleasure. As I always say, thank you so much for doing this. Do not hang up. I will stop the recording. But I'm saying thank you, and cheerio. Looking forward to seeing you in person soon, I hope.
Thank you so much, David. Pleasure as always, and I'm sure we'll see each other soon.
I hope so.